Confidence is quiet, ego is loud. That difference matters more than most traders realize. Most people think confidence looks like decisiveness, speed, certainty, immediate action. That assumption is wrong. What they call confidence is usually ego under pressure. Real confidence does not announce itself. It does not rush. It does not need agreement from the market to exist. Ego does. Ego wants to be seen acting. It wants to be validated quickly. It wants to be right now, not later. That's why ego feels powerful at entry and fragile immediately after. Confidence is the opposite. Confidence is willing to wait in silence while nothing happens. It does not need movement to feel justified. It does not need excitement to feel secure. If a trade requires emotional momentum to be taken, it isn't confidence driving the decision. It's fear of being inactive. Most traders confuse motion with authority. They think acting fast means acting decisively. In reality, speed usually signals internal noise. Today is about identifying that noise before it controls your decisions. Ego is reactive by nature. It does not initiate, it responds. It reacts to stimuli, not structure. A fast candle, a missed move, another trader posting results, a sudden expansion in volatility, that subtle feeling that time is running out. None of these are threats in reality, but ego interprets them as one. Ego does not distinguish between danger and discomfort. It treats both the same. And once something is labeled a threat, action feels mandatory, not logical, mandatory. This is why ego-driven trades feel urgent. There's pressure behind them, a sense that something must be done immediately, or an opportunity will be lost forever. Confidence does not experience this. Confidence does not interpret noise as danger. It filters it out. That's why confident execution feels slow from the outside, delayed, sometimes even hesitant, not because the trader is unsure, but because nothing has forced action yet. Ego wants certainty before acting. Confidence accepts uncertainty as the environment it operates in. That distinction matters more than strategy. Ego wants to feel right. Confidence is willing to be wrong within rules. When you size up impulsively, when you enter early, when you feel a tightening in your chest that pushes you to click, you're not expressing confidence. You are attempting to eliminate discomfort. That's the core function of ego in trading, not profit. Relief. Ego cannot tolerate unresolved tension. Open-ended situations feel threatening to it. Waiting feels like exposure. Inaction feels like vulnerability. So it pushes you to act, not because acting is correct, but because acting ends the internal pressure. Confidence can tolerate unresolved tension. It can sit in uncertainty without trying to resolve it emotionally. It doesn't need closure every minute. It doesn't need feedback to validate its existence. That's why ego needs constant stimulation. It watches every tick, every fluctuation, every micro move, because silence feels dangerous to it. Confidence does not monitor the market for reassurance. It waits for conditions. Ego trades to feel competent, to feel involved, to feel like it's participating in something important. Confidence trades because criteria have been met, nothing more. Most traders never build confidence because they never allow discomfort to last long enough for confidence to form. They interrupt the process. They feel tension, misinterpret it as intuition, and act. Then they feel relief, and that relief is misread as correctness. This is how bad behavior gets reinforced, not through wins, through emotional relief. Over time, urgency becomes normal. Entering early feels proactive. Sizing up feels decisive. Breaking rules feels justified. Patience, on the other hand, starts to feel wrong, weak, passive, even irresponsible. At that stage, ego isn't loud anymore. It doesn't shout. It doesn't rush you overtly. It becomes the default voice, the one that feels reasonable, the one that sounds like experience. And when ego becomes quiet and familiar, it's no longer questioned, it's obeyed. That's how traders lose objectivity without realizing it, not through one emotional trade, but through a pattern of small, justified reactions that slowly replace rules. By the time the damage is visible, ego feels like confidence, and confidence feels like something you lost. Look back at your biggest losses. Not the charts, the decision process. Those trades probably felt obvious at the time, clear, certain. That feeling wasn't confidence. It was ego eliminating doubt. Now look at your best trades. They didn't feel dramatic. They didn't require convincing yourself. You didn't need to justify them internally. They met conditions and you executed quietly. That's confidence. Confidence doesn't feel powerful. It feels boring. It does not rush to be proven right. It does not need immediate feedback. Ego does. That's why ego trades feel strong at entry and weak under drawdown. Confidence feels neutral at both. The market doesn't reward the loudest conviction. It rewards consistency under uncertainty. Ego wants to dominate the outcome. Confidence is content executing probability. Every time you force a trade, every time you justify bending a rule, every time you size up to make it count, that's ego asserting control. And the market is extremely efficient at punishing that behavior over time. Not immediately, but consistently. That's why ego survives longer than it should and destroys accounts quietly. Here's the rule. If a trade needs confidence to be taken, it doesn't exist. Real setups do not require belief. They require criteria. Confidence is not something you bring into a trade. It's something that remains after the decision is made. If you feel the need to feel confident, you're already compensating. The moment you start trying to feel ready, ego has taken over. Your job is not to feel certain. Your job is to execute when conditions remove choice. Confidence is built through repetition without interference, not through emotional conviction. Ego speaks loudly. It urges action. It demands resolution. Confidence does not argue. It waits. If you want consistency, stop listening for the loudest voice in your head. It is almost never the correct one. Confidence is quiet. Ego is loud, and the market hears everything.